Admit it, you feel sorry for the people that are trying to buy houses right now. Good afternoon. So I was reading an article today about how it's great to be a home owner, but it says nothing about how terrible it is to be a home buyer. As a real estate agent for the last year or more, I've basically taken buyers around. Every weekend we put offers in on houses, over asking, over appraisal, and we might get the house, but more often than not, the next weekend we're looking again, putting in offers again. And it is a very frustrating and miserable experience. Now, you could say, well, other people have bigger problems than not being able to buy a house, but I'm telling you, it is really, really tough. So I just wanted to go over some of the stuff in this article. I thought it was very interesting and might help put things into perspective. So here's the article. It says, homeowners are doing a lot better than home buyers. And it says, the past 2 years haven't been kind to Americans who are looking to buy a home or who are renting places to live as home prices and rents have exploded. But it's a great time to be a homeowner. Over the past 2 years, people in that category have seen their wealth rise $6 trillion, excluding rental properties, according to the New York Times, citing a Federal Reserve study. And it's somewhat obvious that the housing market has been great for homeowners and home sellers. But did you know that the increase in wealth had risen by $6 trillion? I mean, that is a huge, huge number. It says that increase, of course, stems from the surge in home prices. Home prices soared 19.8% in the 12 months through February, according to the Case-Shiller Home Price Index. And it's even more than 19% if you look at the past 2 years, as much as 30% or more higher in some areas. I mean, we're seeing historic gains in home prices. Homeowners 62 and older have certainly fared well. In the fourth quarter of last year, they enjoyed a 3.98% increase in housing wealth to a record $10.6 trillion, according to the National Reverse Mortgage Lenders Association risk span. And I don't understand why seniors only got an impression of 4%. Oh, wait, that's just in one quarter. These gains are impressive. As you might expect, the wealthy have made out the best from rising home prices over the years. Of the $8.2 trillion in housing wealth amassed from 2010 to 2020, high-income homeowners claimed 71% of it, according to the National Association of Realtors. And yes, this trips people up all the time. Let's say you have a $200,000 home, and the value increases 20%. That home is now worth $240,000, so an appreciation of $40,000. Now let's take an $800,000 home with a value increase of 20%. You now have a $960,000 home with an appreciation of $160,000. The gain as a percentage is a monster at higher priced homes. It's a wake-up call. Gay Corrington, senior economist at NAR, the National Association of Realtors, said, according to the Wall Street Journal. Policies have to be focused more on making sure that the lower income and many more middle income folks participate in the benefit of home ownership. So why do policies have to be focused more on making sure that the lower income and many more middle income folks participate in the benefit of home ownership? Let's take a $100,000 home and there's a $20,000 increase or 20% increase in the value of the home. That's $20,000. $20,000 in 2022 isn't getting anyone out of their current class. And that $100,000 home is probably going to need at least $20,000 in maintenance and repairs over time. So where is that wealth going to come from? This has the makings of a bad deal for lower and middle income folks. What are these policies that can be focused more on making sure lower and middle income folks participate in the benefits of home ownership? Here are the few policies that we have right now. We have mortgage interest rate deduction, we have low down payment programs, and we have closing and down payment assistance. What more is there to do? Are we talking about setting the table for real wage growth in the United States? Are we talking about defending and promoting upward mobility through changes in banking, tax, and employment law? What is it? It's very easy to say we need to be focused on policies, but what are these policies that are going to do what you're saying needs to be done? One of the latest negative signs for the housing market, the National Association of Realtors Pending Home Sales Index fell 1.2% in March. the fifth monthly drop in a row. Pending sales measured for existing homes slid 8.2% from a year earlier. And as a real estate agent, I'm sure that data is accurate. I disagree with the premise that the pending home sales index portends to a slowing of the housing market. I believe the reason why the pending home sales index has gone down is that there's just no inventory. Within one weekend, pretty much all of the homes that are listed go under contract. The ones that don't are dramatically overpriced. No inventory is going to cause pending home sales to go down because you have fewer sales with no inventory. That's what I think is happening. I don't really think that the market has cooled, at least not in St. Louis and not right now. Meanwhile, the 30-year fixed mortgage rate averaged 5.1% in the week ended April 28th, down a tick from the prior week's 12-year high of 5.11. According to Freddie Mac, the rate was 2.98% a year ago. There was a huge mortgage rate increase over the course of about a month. This morning, I checked the 30-year fixed rate and it was hovering around 5.55%. I'm noticing more houses come back on the market after going under contract. I suspect this is because the buyers have not been in close contact with their lenders and didn't realize there was such an increase in the cost of borrowing money with the higher rates. They were operating under the false belief that the rates were still in the low threes. I've been asking lenders I work with to meet with clients and go over the new numbers with them so they're not caught in a situation where they finally get an accepted offer only to not be able to close on the house. So we're redoing all of our pre-qualification or pre-approval letters, just going over the numbers, making sure that our sellers would still qualify to be able to buy a home. And then because the rates have changed so much and because the Fed just announced a 50 basis point increase in the borrowing rate, I thought that we could go over an article real quick about, what does that really mean as much in the mortgage rates? Because the Fed funds rate is kind of a rate that's set up for all lenders. It's not necessarily just mortgages. So it says the Federal Reserve just announced a 50 basis point hike in the benchmark federal funds rates, which now sits at a target range of 0.75 to 1.1%. While this may sound like an extremely low interest rate, think of the federal funds rate as the rock bottom baseline on which many other interest rates are based. For example, a 50 basis point hike in the federal funds rate means your credit card's interest rate will likely go up by a similar amount. If you're thinking about buying a home, this may sound like concerning news. After all, mortgage rates are already up by more than 2 percentage points over the past year. Heck, over the past 2 months. However, as we'll discuss here, there's not necessarily a reason for panic yet. And there is a false belief that the Fed's funds rates and the mortgage rate move in unison. They are related, but it isn't a one-to-one ratio. This article does as good of a job as I've seen with the explanation, so that's why I'm using it. The mortgage rates and federal funds rate. Here's the good news. Mortgage rates are not directly tied to the federal funds rates, as we just said. In other words, if your bank was offering a rate of 5% before the Fed rate hike, that doesn't mean its rates will immediately shoot up to 5.5% after the announcement. As they're already at 5.55%. As mentioned before, the Fed has only raised rates by 0.25 percentage points up until now, but mortgage rates have risen by more than 2 percentage points over the past year. Clearly, the two don't move in tandem 100% of the time. Specifically, mortgage rates tend to be a bit more forward-looking and are driven by market dynamics like demand and perceived lender risk. In addition to benchmark rates, over the long period, mortgage rates and the federal fund rates tend to move in the same direction, but is far from a one-to-one relationship. And in the example given, the Fed raised the rates 25 basis points, but the mortgage market rather quickly moved 2% or more. So there is a relation. Both went up. But mortgage rates have continued to climb before the Federal Reserve increased the Fed funds rates today. So that had been going on for a couple of months that we'd known that there was a rate hike coming. It wasn't until today when they actually announced it. What it could mean to you? In short, mortgage rates moves based on conditions in the mortgage market, not because of the federal funds rate or any other benchmark rate. It's entirely possible mortgage rates will continue to rise in the weeks and months to come, or they could stay the same or even come down, despite what the Fed is doing. That said, the 30-year mortgage rate hit 5.55% last week on average after starting 2022 at just 3.29%. This means that on a $300,000 fixed rate mortgage, the principal and interest portion of the monthly payment has increased from $1,312 to $1,713, which is 31% more expensive. And just for illustration, if the average 30-year mortgage rate were to continue to rise by another 50 basis points in line with the Fed rate hike, that monthly payment would increase further to $1,808. So it's fair to say rising mortgage rates can dramatically impact home affordability. This is a good example, and exactly what I'm seeing in the housing market. A $500 a month increase in possible mortgage payments is going to affect affordability because it's going to affect your debt to income ratio. It also means you have to find an extra $500 per month in addition to higher gas prices, higher food prices, etc. The triple whammy of higher house prices, higher food prices, and higher energy costs are going to have an effect on the low to middle class and their home search. Don't forget that with the increase of property values, there is going to be a corresponding increase in property tax, which further strains the home buyer wallet. Mortgage rates can be unpredictable. The key takeaway is even though the Federal Reserve makes clearly defined interest rate hikes, mortgage interest rates still move in an unpredictable manner governed by economic forces. Over time, however, the federal funds rate and the average mortgage rate tend to move in the same direction. So if the Fed continues to hike rates throughout the 2022 year, as most experts are predicting, it could certainly put upward pressure on mortgage rates. And as a real estate agent, I tell my home buyers that some people do get lucky and time the market just right. An example of this would be someone who is looking to downsize. They would easily afford a smaller house. However, the person who owns a house and looks to move up is going to have a hard time finding value in their home today. We also don't know the future. We don't know where interest rates will be next year or the year after, etc. Surely along the time span of 30 years, mortgage rates will fluctuate. If you are buying now, there may be moments to refinance in the future. Also, regardless of whether or not the Federal Reserve causes inflation or tries to limit it, home prices generally move up over time, which is why it's not a bad thing to buy a home early in life and hold it for as long as possible. That's what I tell my buyers. It's a tough go. I mean, and don't kid yourself. It's right now, it's just tough. But, if you're going to buy and the market goes down in the next year, it's okay. The people that bought 2 years ago are up 30% in equity already. So I'm not saying go run out and buy if you don't need to buy. Don't make a run on houses. There's already a run going on. I'm just saying that if you have to buy, if you have reasons to buy, understand that rates are going to go up. Things might cool down or they might not. We just don't know. So that's what I have for you today. Thank you for watching. Thank you for listening. I'll catch you on the next one.